Hello, everybody. Welcome to Thursday. The S&P 500 was down 1.4% today, really driven by a couple of Fed governors who came out today with some very aggressive comments about interest rate increases. And so the Federal Reserve has a lot of different things that they can use to try to drive down inflation to their 2% target. They're using quantitative tightening to reduce their balance sheet. They're raising interest rates. But one of their strategies all the way through since this started really in November of 2021 is this concept of being very aggressive with their speaking and what have you, and coming out and talking about how much they think rates will come up and those types of things. Usually when they're not trying to tighten money supply, you don't hear these types of comments, but that's certainly what's happening right now. And so we had both of these Fed presidents talking about the fact that a half a point rate increase would be okay. They see that as something that they would vote for. The interesting thing is that neither one of them are actually voting members right now for what would happen with rate increases. So, but they're, a long line of different Fed presidents and governors that have been coming out and speaking. I find it fascinating that one of the biggest runs we had this year was during the quiet period when the Federal Reserve is not allowed to speak. This is right before their meeting and after. And so, they're just continuing to come out and say what they're going to say as far as that goes. And it is a good time, in my opinion, to be defensive in this environment. We are getting some higher inflation numbers. The producer price index came out today, supposed to be at 5.4% year over year. It was at 6%. That's a pretty high jump over what it was supposed to be. Producer price index is what they, the inflation that they see at factories and at the, say, the shipping, docks and those types of things. And so it doesn't always get passed on to the consumer, but it does eat into margins potentially, and which is really important also. So definitely seeing a blip, to the upside in terms of inflation. And of course that, combined with what the Federal Reserve is saying is kind of scaring things. And so we have on Monday moved into utilities, high dividend paying stocks and energy. All of those outperformed, the Vanguard Total Stock Market Index that we use as our, main measurement of the markets as far as that goes, and beat the S&P 500 for that matter. On the bond market side, we moved into, short-term treasuries, short-term tips and inverse bond positions. All of those have been doing well really all week long versus the bond market. So I'm not surprised. The bond market's been, showing higher and higher interest rates. Usually the stock market goes down in that environment. It held up pretty well, but today we saw some of that, kind of just giving up on that a little bit. And so again, I still think the bond market is a bit of a, a leading indicator for where the stock market might end up going, if you watch that closely like we do. So anyway, that's what's happening today. None of this is really bad. In the end, we'll have to see how this goes, what the Federal Reserve does. At some point in time, the Federal Reserve will back off of this commentary and the markets can start to do, I think some good things. But it's probably time to be a little bit defensive until we see how this inflation plays out and see how the Fed handles this here, over this short period of time anyway. So look forward to seeing what's going to happen tomorrow. We do not have our show tomorrow, but I will be doing a summary that I'll put out on the channel also for the week. So look forward to seeing you then. Thank you.